What if by 2035 the world's largest economy isn't the United States, and yet America still isn't poorer? For years, experts predicted China would overtake America by sheer force of scale and speed. Now, with 2035 approaching, the data tells a far more complicated story. In 2000, the U.S. economy was more than 4 times larger than China's in nominal dollar terms. China's post-1978 reforms unleashed decades of 8 to 14% annual growth, lifting hundreds of millions from poverty. By 2010, China surpassed Japan to become the world's second-largest economy. By the mid-2010s, measured by purchasing power, China had already edged past the United States. Major forecasts between 2010 and 2020 projected a nominal GDP crossover around 2030 to 2035. The logic seemed simple: a population 4 times larger, massive infrastructure spending, and centralized policy coordination. But around 2021, momentum shifted as China's property sector, once a pillar of growth, began to unravel. Highly leveraged developers collapsed, construction slowed, and household wealth tied to housing eroded. At the same time, demographic pressures intensified as births fell below 9 million annually. The working-age population began shrinking by 5 to 7 million people each year. Youth unemployment climbed, domestic consumption weakened, and regulatory tightening cooled private investment. The assumption of an inevitable Chinese overtake suddenly looked less certain than it had a decade earlier. Meanwhile, the United States faced inflation spikes, political division, and a national debt exceeding $35 trillion. Yet despite these strains, the American economy proved more durable than many expected. Real GDP growth averaged roughly 2.4 to 2.8% in recent years, modest but consistent. Advances in artificial intelligence began delivering measurable productivity gains across logistics, finance, and healthcare. Shale extraction restored energy self-sufficiency, turning the United States into a major energy exporter. Continued immigration supported labor force expansion, offsetting demographic stagnation seen elsewhere. Even 2% real growth combined with moderate inflation translates into 4 to 5% nominal expansion in dollar terms. By early 2026, U.S. nominal GDP stood near $30 trillion, compared with China's roughly $19 trillion. That gap of about $11 trillion equals more than half of China's current output. To close it by 2035, China would need to grow significantly faster than the United States for a full decade. Official Chinese growth around 5% contrasts with independent estimates closer to 3 or 4%. Structural headwinds include debt exceeding 300% of GDP and persistent deflationary pressure. Currency dynamics matter as well. Depreciation slows nominal convergence even if real growth remains solid. Major institutions have revised timelines, pushing any crossover into the 2040s or even later. The probability of China leading in nominal GDP by 2035 is now widely viewed as possible but far from certain. Even if China edges ahead in total size, per capita income tells a very different story. Today, the average American produces over $85,000 annually, compared with roughly $13,000 in China. By 2035, that gap is still projected to remain 4 to 5 times higher in the United States. Aggregate GDP shapes geopolitical leverage, but living standards define whether a nation is truly poorer. A $48 trillion China versus a $46 trillion United States would represent a narrow symbolic crossover. Yet American households could still earn the equivalent of $120,000 in today's terms. Meanwhile, China's per capita income may rise toward $28,000 to $32,000. Major progress, but still far behind. Historical precedents show that rapid convergence often slows once structural constraints take hold. Britain yielded leadership to America through scale and innovation, not sudden collapse. Japan's projected overtake in the 1980s never materialized after property and demographic shocks. China now faces similar pressures: aging, high debt, and diminishing returns from infrastructure expansion. The United States retains advantages in institutional flexibility, immigration, capital markets, and frontier research. Most updated forecasts therefore suggest either continued U.S. leadership or near parity by 2035. In either case, America is unlikely to be poorer in nominal terms and almost certainly not in per-person prosperity. The more plausible future is competitive coexistence, 2 economic giants sharing leadership without either fully eclipsing the other.